It's Mike Lynch with AmeriFirst Financial. Happy Monday morning. It's time for your Monday morning mortgage update for the week of September the 26th. Man, this month is almost gone. Hope everybody had a great weekend. I had a great weekend. Rode my mountain bike, rode my road bike, hit golf balls in the river with friends, spent some relaxing time with Gail. Just had a nice weekend. So let's get to it. I got a lot of stuff to cover today. So what happened last week and what's happening this week? We all know the Federal Reserve raised the Fed fund rate another 0.75 of a point on Wednesday. It was probably the most important meeting of the year that they've had. And it wasn't so much raising that rate, it's what they said. I sent out a special report that really broke that down. If you need it, if you didn't get it, let me know. It's worth watching. But what happened last week is pricing got worse by over 100 basis points. That means that there was a market sell-off on the bond market. Money flowed out of that bond market, and pricing got worse over 100 basis points. The week before, over 100 basis points. Since October 2nd, let's look at the chart here because it's really interesting to look at this. If you look since October 2nd, this big downturn, red meaning that money's flowing out of the bond market, we've really seen a deteriorating bond market. And this is a representation of mortgage-backed securities in the bond market. It's where mortgage rates are determined. They're not determined by the Fed raising that rate. This is determined by the trading of mortgage-backed securities in the bond market. And when we see red, we see a little greens in here, which the market slightly improved. But when we see this go down, that basically means that rates are getting worse. And there really was a sharp decline, a more drastic decline in the market starting September 12th, a couple weeks ago. And you can see a big decline. But one thing is interesting. If you look on the 21st, which was last Wednesday, the market actually improved when the Fed raised their Fed fund rate. But then on Thursday, on Friday, and today, big sell-offs in the market, huge sell-offs. So we'll talk about that. Let's talk about what we're looking at. I always try to give you three things that are going to affect the market. Number one is inflation. That's no surprise. Number two is the Fed. And number three is I want to talk about how long we can expect this to last because it's getting worse and it's affecting all of us. It's affecting our business. It's affecting our clients, our buyers and sellers and what they want to do and what they're willing to do. So let's talk about inflation. We all know that inflation is the death of mortgage rates. And I'll talk about that. But inflation in the U.S. is not just the problem. It's inflation around the world. We are in a global economy. Well, this week on Friday, the PCE, the Producers Consumer Index, some key measure of inflation that the Fed likes to pay attention to. It strips out food and energy, which are at the highest costs that they've been, and really looks at our core economy. And we expect that to go up. So if that PCE report that comes out Friday is higher, showing higher inflation, guess what? Rates are going to go up too. The Bank of England, this was really the biggest issue that we've seen over the last couple days. And if I go back to the chart here, you can see that the day after the Fed raised the Fed fund rate, huge sell-off in the bond market. Today, if you look at the charts today, we're over 100-point sell-off in the bond market. So think about that. Last week was over, the whole week ended with over 100 points. The week before, over 100 points. And just today, it's already a 100-point sell-off. Why? Because the Bank of England, which is a major economy around the world, is finally saying, wow, inflation is a problem. Now, keep in mind, they have, and a lot of economies around the world have really ignored inflation. Our Fed ignored it, but they really have. Their equivalent of Federal Reserves. And now they're really realizing it's a huge issue. And Europe's even having a bigger issue because their energy costs are expected to go up over 200% this winter. They've had big problems with food costs, all because of the Russian invasion of Ukraine. It's causing major problems over there, on top of the fact of our fallout from the COVID and all the problems that we have all had globally because of how that was handled. And really that's what's pushing us into a recession. So bottom line is that Bank of England, now that they're starting to say, hey, we're going to probably raise our Fed fund rate, their equivalent, over 200 basis points by the end of the year. This is a huge increase. And that's really having widespread effects around the world. And it's absolutely affecting our bond market. The second thing is the Fed. So last week, the Fed met. This week, all the Fed members are going to start talking and interviewing and giving their insight on what's happening with the economy. And really what we're looking for is, are they in line with the general Federal Reserve policy? Are they going to say things different? How do they see, those individuals see the economy moving forward in the next year or two? When is the recession really going to hit? We're already technically in one, but our administration is not admitting it. How long and how hard is this recession going to be? And then the last thing is, how long will this last? How long will these high rates last? How long will this start to affect the housing industry? And so it all depends on how long inflation will stay up. And important things to understand about inflation. So it's horrible for interest rates. Why? Think about this. If you have a $1 million dollars in a bond and that yield is 4%, or the rate is 4%, inflation is 1%, your actual rate of return is 3, right? 4 minus 1 is 3. Now, if you have that 4% bond that you purchased and the yield's 4%, but inflation is 3, you're getting a very meager 1% rate of return. So what happens is those yields start to go up, which really equals rates, to give investors a rate of return. Now, that's a very simplistic way of explaining it, but that's why generally inflation is bad for bonds, and mortgage-backed securities are traded in the bond market, and that's why we're seeing our mortgage rates go up. It's not because the Federal Reserve is raising their rates. It's because inflation is out of control. The second thing about inflation is the Fed raises that Fed fund rate like they did last week to fight inflation. Why? Because when they raise that Fed fund rate, it makes things more expensive. Businesses more expensive to operate. People buy less stuff. Businesses eventually lower their prices. That lowers inflation, and that's a very, very draconian way of doing it. And 3, many of the top economies around the world are also experiencing inflation, worse inflation than we have, and we are a global economy, and it absolutely has an impact on our economy. For fighting inflation takes time. As the Fed does this, it doesn't just flip the switch on inflation overnight. It takes time, and we have to weather this storm. Has raising this Fed fund rate and fighting an inflation put us into recession? Absolutely, unequivocally it has. We're technically already in a recession, and the real question is how long and how hard this recession is going to be. Now, keep in mind, the housing markets, typically, if you look historically at recessions, you exclude the last big recession we had in 2008, 9, and 10, which was caused by the housing market. The housing markets actually have done fairly well. Rates come down during a recession, and housing values typically hold their own. So it's going to get harder before it gets better. The real story is, or the real comment is, how do we advise our clients? What do we tell them? And how do we answer those difficult questions? So the general consensus is that we're going to be in this rate market for the next 6 to 9 months. Starting in the first quarter or the second quarter of next year, we're going to start to see inflation come down, which will then affect those interest rates. So if you have any questions or comments, please let me know. Oh, one thing, we are absolutely in a locking position. We're not floating the rate. As I showed you on the chart here, the market is already up. Now it's down below 100 points. This is a live read, but we are absolutely locking interest rates and not floating. If you have any questions or comments, please let me know. If you know somebody that could benefit from this video, please forward it to them. Have a great, productive week, and we'll talk to you soon. Bye-bye.